Yeah. Am I recording now? Yes. All right, the red light is on. So let's get this show on the road. So welcome to the Practical Wealth Banking, Private Family Financing in Action, Banking 202 series. So I want you to keep a lookout for your email because we will do this type of call once a month, but I have another webinar I'm scheduling on cash flow management, on building financial independence, and so I'll just keep, look, we're going into education mode. I want everybody to go into 2020 with a game plan and with a strategy to build economic independence. So in our system, we call that being a cash flow nair. And so our goal is to get you to what we call the FU position. So you can take anybody to take a flying leap when you want to, but that means you have passive income twice your expenses. We want to eliminate your non-preferred debt, and we want you to have a financial fortress built around your personal economy so you can thrive in good times and bad. One of my favorite books on banking is called Money for Life. And so in Money for Life, there's the 4 pillars of a strong personal economy. And so this is the end of the movie. So the 4 pillars of a strong personal economy, as we get into this, are 1, freedom from debt to others, okay? So the whole idea of privatized banking is, listen, is you need to control the banking function in your life and stop transferring your wealth away to other people. So we're gonna go on that a little bit later, but that's what this talk is about, pillar 1. Pillar 2 is ready cash when you need it for emergencies and for opportunities. Pillar 3 is passive income you don't have to work for and that you can't outlive. And pillar 4 is building a legacy of wealth and wisdom, right? So if anybody's not interested in those 4 things, you probably should jump off the webinar because that's what this is all about. So tonight, we're going to be talking about in detail, pillar 1, how do you replace debt to others, where if you're going to be in debt, then you're going to control and get that money coming back towards you. All right. So let's get into a little bit. So what happens is, y'all know me, I'm Curtis May, Practical Wealth Advisors. We help our clients use their own private family bank. Why is that? So they can learn to have money move towards them, interest towards them, instead of away from you. Like most people, money comes into your personal economy and is leaving in the form of debt. And the goal is to help you build generational wealth. So hopefully that's what you want. So let's talk about what is private family banking. So it is the creation and utilization of a private pool of money, capital. So capital money, interchangeable, right? That is controlled by a private individual, you, your family. But think about this, the one who puts the money in owns the bank. The one who owns the bank receives the what? The profits from the bank. Everybody say profits, right? And so banking is the most important business in the world. Every business transaction, see, banking, as Nelson Nash used to say, is. People say, well, I don't understand it. Well, you do it all the time. You just don't own the bank. All we're trying to do is show you how to be in control of the banking. So every transaction requires money to flow from one party to another. And that money must flow from a pool of money somewhere. So banking is all about controlling a pool of capital, i.e. money, that can flow at cost to meet some needs you have. So that's all it is, okay? And so all right, so that's the deal. All right, mute yourself. All right, so now, let me keep going here. So let's talk about how do banks make money. So I always like to review this because what we're looking at is not getting a charter and being United Bank, but how does their business model work and how can you duplicate that in your personal economy, okay? And so how do they make money? Well, let's think about that. So let's take Bank of America, right? And so one of the things Nelson Nash, Shakespeare said, all the worlds of play. And so what you got to know, you got to know the players in the game, okay? Players in the play. And so everybody's got their role to play. So let's look at banking as you do it now. So it's three people in that equation. There's the saver or the depositor. There's the banker, the institution of the bank, right? And then there's the borrower. And so most people on this call are one of the two. So they're the depositor, and probably the borrower also. You're both, but very few are actually controlling the middle part right here. And so let's look at what goes on here. So Bank of America has, what's that? $1,036,889,000 in deposits. Okay, that these savers that they're managing for Bank of America. So they paid out $9.3 billion with a B in interest. But, but look away, I'm looking at two screens. But on the money they loan out, they're making almost $60 billion. And so here's the question, whose money are they loaning out? And guess what? It's not theirs. They're loaning out your money. So what happens is they have paid, that is a representative of, they've paid out on average less than 1%, 0.88% on the interest they're paying out. So, because you understand, when you put money into a bank, you're loaning them money, right? You're unsecured, this is worse than that. You're an unsecured creditor, all right? And to the bank, right? And so you don't own them no more. They have it, and they're doing their thing, right? And so they have the equivalent of earning 5.8%. And so, big deal. That's only a 5% spread, but that is a 660% spread. So now, I think I have some big time real estate investors on the call. So how many people or Wall Street people are earning 660% on their money? That is the power of banking. So would you like to be in that business where you get a 660% spread? That's what we're talking about. This is from Bauer Financial. This is the latest issue of a report that studies banks. And so what happens is, the goal of this part, and I always like to start out warming people up, for those who are less familiar with the strategy, is that everyone should have two businesses, okay? The one that gives them a paycheck, your job or your insurance business or your real estate business or your network marketing business, wherever you're doing to generate revenue. But the second business should be their banking business, right? Which finances everything that you do. Because when you get paid, it's going into somebody's bank. And when you send money to other people, it's going to somebody's bank, and you're not making any money off of any of those transactions. And so what we're trying to do is show you how to adopt that business model into your life. So now what I'm going to do is I'm going to have my business partner, Yvonne Burke, who's one of the top practitioners in the country, out there in Las Vegas, but she's an Abington girl, Penn State girl.
Going in the Lions.
And so what she's going to do, she's going to take over. And
I need video, I think.
Yeah, wait a minute. I'm going to, I don't know. Ellie.
Oh. They don't need to see me as long as they can hear me.
Yeah, wait a minute. I know. My 9-year-old is distracting me here. Hold on. No. All right, hold it. Sorry. Live video, folks. I can't find you. There we go. All right. Let me stop the share. First, I got to do that. Okay. And
yeah, you just need to make me allowed to share my screen.
Yeah, there we go. All right, more. Make host. Okay, there you
go. It says host disable participant screen sharing.
You're the host now.
Oh, yay. Okay, perfect. Let me just start the presentation right where you left it. Hold on.
And your videos, I don't know if you want your video or not.
Yeah. Oh. Can you guys see? Do you see the PowerPoint?
No.
Okay. Let me Hold on one second, you guys. Now you should be able to see something, I hope.
Yeah. Yeah, now pull your PowerPoint out.
Let me just, I'm gonna display it differently. Okay, so thank you again for joining us. For those of you who were here last time, certainly, thank you for joining us then. And to go for the new ones who have not been here, that were not here last week or last month, I want to just kind of review a little bit of what we talked about. And today I want to go over a simple tool for creating a killer debt repayment plan. We kind of touched on that a little bit last month, and we're really going to go through a debt reduction sheet so that you guys can see how to utilize your banking system to reduce debt or whatever your goals are. But before we do that, I think it's important for us to talk about the annual pattern of spending. Where are we sending our dollars to? And when I talk about money, I'm going to talk about money, and I'm going to use it $1 so that we can simplify and make sense when we talk about how much of your dollar is going in which direction. So first, we're going to start with automobiles. So about 20%, 20 cents on your dollar goes to spend on your automobiles, which, right, we all need, obviously. And about 30% is going for housing, your home, apartment, rent, however, whichever one of those you're using. The next one would be for living expenses. That's another 40% that is going towards living. And then we're doing a 10% savings, which when you really look at the graph, it's amazing that the smallest number that we're doing is money that we're keeping for ourselves. We tend to give our money away, and therefore we always end up month to month in the same place. A check comes in, all the money goes out to auto, house, living, and we have very little to save. But on top of that, to make it even worse, we have to deal with the interest that you're paying to other banking systems, other lending institutions. So on an average, there's about a 5% interest rate that gets paid on automobiles, the 25% of interest that goes into housing, and about 5% for living. And when you add all that up, it's 25, 30, 35 cents of every single dollar that you spend on a monthly, yearly basis is going towards interest into someone else's banking system. And what we really want to focus on is how are we going to reroute that so that that dollars comes in and we can then change the flow of that dollar instead of going to interest, going to our own banking savings accounts, okay? And once you understand how spending works, then you can really understand what you have to do to create the systems to be able to flow those dollars, like what Curtis said, back to yourself. Before I get started on the actual debt reduction, I want to kind of review the IBC loan process. We kind of went through this slide last month, but I'm going to start again just to refresh everyone so that everyone, especially the new people that were not here last month, see how to really set up. So you're at the point where you have started your policies with Curtis, and now the first step is always to fund the policies. You have your earnings, you're going to deposit, you're going to put in, you're going to pay your premiums for your policies. And once you put that in there, there's an insurance company that's representing these policies that's paying you a 4% interest on your gross cash value, plus you're also earning dividends. This is where really the compounding interest, everything that's going to flow through has to flow through these policies first. Once you're ready to start doing some debt reduction and or some purchasing, then now you have to set up your segregated bank account. That segregated bank account will be, and it could be just a regular checking account, that will be the holding pot for the flow of money between your policies and whatever debt or whatever it is that you're going to be purchasing. And once you're ready to start using your banking system, you will create a loan. The loan is not coming from your policies. The loan is coming directly from the insurance company. You're leveraging their dollars. Anytime that you're able to use someone else's dollar, just like Bank of America does, right? They use our dollars to go lend it out. Now you're really doubling the value of your dollar because the cash value inside of your policies, that gross cash value will continue to earn 4%, even though you've taken out a loan. So your money's growing while you're using your money to pay debt and or to grow and or to retire, whichever your goals are. Because you're doing a loan from the insurance company, they have to charge you some type of an interest. And the company will charge you a 5% interest, but it will credit you a 4% gross cash value rate. Therefore, your net loan rate will be a 1%. And we're going to talk about this interest when we go through the presentation on how to maximize that, getting that interest back into your policy. Once you get the money into your segregated account, then you go out and you do your purchases, whether you're paying debt, purchasing, lending, whatever you're going to do. But the most important part of creating a banking system is really, once you do all this, is having a loan repayment schedule, a way to put the money back into your system so that you can use it again over and over. That creates velocity. That creates the use of that dollar over and over. And the more times that you can use the same dollar, the greater your wealth will become. And once you set up your loan repayment, and we'll talk about this, into your segregated bank account, once a year, we will send back to the insurance company, and that will only rebuild more cash value for future purchases, okay? So let's start with the basic policy, and we're gonna do a very simple $10,000 premium. 4,000 of the premium will be going towards the base. That is the cost of the insurance. And that $4,000 will buy this client. And I just did a random 41-year-old, I think I put a female, because I think I got tired of always everything being male. So my girls out there, I think I did a female, yeah. So we put a $4,000 base, and then we did a $6,000 PUA premium payment. That's the additional cash that's gonna go straight into the paid up additions rider to build up that cash value bucket. So as we go through the debt reduction, please remember this illustration. I want to point out a couple of things in this illustration. If you look at year one, you will see that there is a $10,000 premium and your cash value available in the circle is $6,243. And a lot of people say to me the first year, well, how come I put in 10, but I can only have access to 6? The reason is because there's a cost of insurance. There has to be an operating cost of having that $335,000 or $333,000 worth of life insurance that is really paid in the first couple of years of the policy. In this particular scenario, when you go to year 2, you can see that the client pays or deposits $10,000, but the cash value increases by $10,124. And I want you to think about what that means. It means that for every dollar that is put into the system, the policy grows by a greater number, $1.12, right? So when you think about these policies, I want you to think of them like little franchises, like little businesses, because anytime that you have an asset that you can deposit $1 and you can take out a greater amount than what you deposited, will always be a win. And when you think about your systems, you want to think about, gosh, this is almost like a franchise. If I had a business that was yielding, right, $1.10, $1.20, $1.30 for every dollar that I invested, how many of those would I want? As many as possible. This is called a cash flowing policy. Look at year 3. We have a $10,000 deposit. The cash value increases by $10,355. Year 4, $10,000. Again, and it will only continue. Now you'll notice in this illustration that I, on year 6, dropped down the PUA premium. And I'll tell you why I did that when I go through my debt reduction. But what's important to know is that we want to be able to manage the system so that it buys further more policies. The more policies you own, the greater the buckets of money that you will have. And I'll show you that down the line, okay? Curtis, you want to stop for questions here or should I go?
Sorry, I muted myself. So I don't see any questions coming in there, but I want you to see that, I was thinking about them, I was trying to chat with them directly. It's like, look, so if this was 100,000, this would be about 62,000, right? And then the second year, I know somebody that's trying to do that kind of premium, it would go up by 100,000. So this is how that would work, but you could access it to do whatever it is you got to do, to invest, to do private lending. But we want to show this because it's not a bank account. It is a saving strategy but it's a contractual situation. So it's important to us that you know how it works. And a picture's worth 1,000 words, because what saving strategy can you put in 10,000 and then the next day get out 11? You put in 4, it goes up by 5. You put in 4, it goes up by 5. And that's a saving strategy. And that don't count what you're doing with this money over here. And oh, look, you may pass away, God forbid, not anytime soon, but now you leave a tax-free death benefit to your family. And we
Exactly.
the foundation of your personal economy. That's the worst case scenario. Okay. If you don't do any stuff we're about to show you, this is what your personal economy looks like. Okay. And it gets more efficient every year.
Well,
So
and I also want to point out, look at age 65, year 24, right? You put in 4,000, but the cash value grows by 13,736. That is one of the buckets that you could use to supplement your retirement income on top of Social Security and any other pension plans. So the policy only gets better, the policy only grows better. And not only does the cash value growth, but the death benefit continues to grow right along with it. So really it's a win-win year after year. And the longer and the more that you fund, the better that the policy will perform. That's why it's important to flow all the money, try to flow as much as you can through the policies first. Okay, let's go to the next one. So now let's talk about the debt management plan. And it all starts with listing out the debts that you want to be recaptured. I've made an example here of a credit card. This happens to be a client, and it's a true client who had these 4 credit cards, and these were the debts. And this particular form, by the way, Curtis has access to. This is step 1. You must make sure that you list every single debt that you want to attack with the plan that you're putting in place for your loans that you're taking out. Now, this could look like this for credit cards. This could be a college payment for your children. This could be even a retirement. This could be paying off your mortgage. This could be buying a second property for a real estate investment. And normally, we have our clients list these debts from smallest to largest. We have found that the smaller the debt, the easier it is to manage paying those off. There's an argument out there to be had, and some clients prefer to attack it by interest rate. If you look on the far right, you'll see that the Discover card has a 22% interest. Someone may say, well, I'd much rather pay that off and not have that 22% interest. And this is something that Curtis or myself help you kind of put together and strategize on which way you want to attack the debt. For this particular example, however, we're going to go from the smallest to the largest, okay? And this is the strict debt, credit card debt payoff strategy.
let me just jump in here. Also, so we've got guests invited here by Troy Slaffy. So if Troy's your coach, then Troy has access to this also. So you can reach out directly to him and he can help you with this.
Yes, and it could be any spreadsheet, it could be any which way, but it's really, really important to really know what was the original balance, the current, what it is that you're paying monthly, and what is the interest rate that you're being charged for using their money. Because when you think about it, you go to Kohl's, you buy something, you charge it, you're not using your money, you're using their money, but they're charging you 18.5% to use that money, right? So we want to see how we can take that 18.5 and send it back to yourself. And that's what we're going to talk about. So we're going to start with what we call the debt reduction schedule. And I want you to notice a couple of things. Here are the debts listed from smallest to the greater one. And you will notice that we always are going to, and by the way, these are things that once you give us that debt reduction sheet, we generate a spreadsheet for you. We kind of list each and every one. You'll see that 1, 2, 3, and 4, how much you're paying a month. You'll see how much the balance is and what the interest rate is. This is important for us to be able to, when we do this debt reduction schedule, be able to understand what is going to be the pattern, which ones will get paid off first. Now, it all starts with the deposit, as you can see on the policy one outlay. And the very first thing we're going to do is we're going to take a policy loan immediately. We are going to fund the policy today, and as soon as the policy is issued and paid, we're going to turn right back around and take out $6,000, and we're going to put that $6,000 out of the policy loans that we're going to do into our segregated account. From there, we're going to be able to pay off 2 of the bills right away. We'll be able to send in $2,500 to Kohl's and knock that bill off, and then $35 to Discover. When we'll,
Yvonne,
but
show the other slide first. I want them to make sure they connect those dots.
the one before this one?
Yeah, the one for this one.
Are you talking about this one?
Right. So what you're going to pay off, I just want to see this. So this is the current balance. It was Kohl's and Discover. So you borrowed $6,000. So now go forward. I just wanted them to see that. So, and the payments are $220. So notice that. Okay.
Right, and that's listed right up here.
Yeah.
We copy exactly what your debt reduction sheet says into, and by the way, I have had debt reduction schedules that has 20 different things. You know, some people are heavily living on credit. Some people have larger debt. I have done these for people who are simply paying their mortgage off, and that's all that they want to focus on. Some people feel that paying their mortgage off is important, and that's what they want to do first. Normally, that's the last thing that we attack, because that would be such a large asset that we want to make sure that your cash flow, what your monthly dollars, you're retaining as much as that before we start attacking a mortgage type of situation. Although I got to say, Curtis, that we have paid off a $1.4 million house in 6 years using the strategy.
Yeah, we did that
so
we did the replay from last month. And
yes,
we'll see
yes.
that.
And in one of these months coming up, we are going to do a real estate investing mortgage payoff class, just to show you how to attack if what you want to do is pay off your mortgage. Okay. So we have taken out the loan. We're going to go ahead and pay off those 2 cards, and we're going to allocate that $100 and that $120 back into your segregated account as a loan repayment. It doesn't mean that you pay those off and then you forget about it. If you were sending those dollars to Kohl's and Discover, a true bank, to become a true banker and really act as and assume the banking equation, be your own lender, you have to make sure that you put those payments back into your segregated account. And that's where this $220, so now you're adding $220 every single month to the policy. What happens then is, here comes the next year, a year goes by, and now you're going to make another deposit of $10,000, which is your premium. You're going to go ahead and add the $220 that you were adding, and you're going to immediately turn around and get another $6,000 loan. But now you have an additional $2,640, which is the $220 times 12. So every time you make a payment back, instead of making someone else, Kohl's richer, you're actually accruing more dollars in your cash value. At that point, we can now take and say, hey, now we're going to go ahead and pay off the Capital One that we owe before, because now we can attack that $7,089 bill, and the remainder I'm going to throw to the principal on the MasterCard and bring that $7,800 down to $6,240. By the way, while you're waiting to pay the other bills, you usually recommend that you pay whatever minimum amount is due on your credit cards for that time while you stash more money into your banking system. It will be more efficient if you're paying, let's say that the MasterCard, let's just say that the minimum payment was $75, but this lady's happening to put $150. We will tell you, just pay the minimum until we stash more cash, and then we'll do a lump sum payment. So you will see that now we're able to pay off the Capital One after a whole year later, and now we have knocked off 3 debts, and now we only have the $6,240. But what must we do if we pay that off? We have to make sure that we add that $100 now to our payments every month, and now you're paying back $320 to yourself. The important part to remember is that these payments here, and I made them very simple, and we're going to talk about charging yourself interest and why you want to charge yourself interest. But this is just if you were going to put back exactly what you're sending to those institutions. So there is no change in your monthly flow. You're already paying $320 a month to all these credit card bills. You're continuing to pay $320, but this time is to yourself. And I will tell you that one of the things that I see when we put these kind of plans together, and the biggest failure of this program is when we get to this point and the client says, oh gosh, I don't know if I want to put that 320, which amazes me because they were paying it to Kohl's and Discover and Capital One, but yet for whatever reason, people don't think that paying to themselves as a benefit. This is a very, very important component of being your own banker. Bank of America is not going to not take your payment and add it to their pool of money. When you pay your car payment or your mortgage, a huge chunk of that goes to principal for, to interest first. And that interest, right, goes into their banking systems. What we're saying is now those payments are going to be going into your banking system. Does that make sense, Curtis? Do you want to expand on that?
I mean, it makes a lot of sense because so now one, I want to make a point. The 320 is in the segregated account. So
yes.
Literally you're paying yourself back. It's in the checking account, ready to be deployed. And
yes.
The other part of that is if you send extra money, like you send extra money to a car payment, and it's they're not sending that money to the depositors. That money is flowing back out to another lending pool. So when people say, well, I want to double down on my payment, or here's the other one that I get a lot of. I'm gonna do a webinar, probably a thing on this one. Velocity banking. I don't know. I have one of my clients that just loves the idea of I want to get a line of credit and I want to pay off my mortgage. But that does get you out of debt. But does getting you out of debt create wealth? Because all you're doing is see the difference with this and that is who owns the bank? That's the question, right? That because this is keeping that money under your control. So the one that owns the bank receives the profits from the bank. And you got to see, this is all about how you think. This is why we have to reinforce this, because you've been trained 30, 40, 50 years of your life. You've been brainwashed to give your money away. And so you got to, it's kind of like, we giving you the red pill every Monday, every month, 1 hour into try to pull you out of the matrix. Okay. So anyway, that's all I want to say about that.
Yeah, I want to answer a couple of the questions that just came in. From Rhonda, she says, so is the actual cost of loan 300 at 5% and we're paying more? And that's a great question. And really the cost is not 5% because you're getting credit at 4%. So your cost is actually 1%. That we're paying more, and I didn't reflect that in this payment, but what you want to add to yourself above and beyond what you were sending to these companies is you want to charge yourself an interest rate. And I'll show you that when I show you the amortization schedule, Rhonda, on how you can charge yourself interest to increase those payments so that more money gets put back into your banking system for future use. By the way, I want to make sure that I make the clarification that this cash that's going into your segregated account is completely liquid. If there happens to be an emergency, if there happens to be an unexpected bill or something that comes up, that money can be deployed immediately to take care of those needs. So I don't want anyone to think that the money that's going into your segregated account that you're paying back, you cannot use at any time. I also want to say that it's completely up to you whether or not you put the money. There is not going to be a bill that's going to come from the insurance company every month asking you for a payment for the loan. The insurance company does not care that the loan is out of your policy because the death benefit is the collateral to your loan. So if anything were to happen to you and you had all these outstanding loans, the death benefit would clear those loans out. It will take care of it. So whether you choose to repay yourself or not, that's up to you. We encourage it, obviously, but most importantly, it has flexibility. And I'll give you a perfect example. It is the month of December. I would like to have a nice Christmas. I have lowered the amount that I'm paying myself to my segregated account, going to the policy so that I can spend a little bit more money on Christmas. You have the control of increasing, lowering. And the second question from Michael Crook, should your premiums be paid out the segregated account? Absolutely. You want to have the segregated account be where your money flows in at all times. money into the policy, money out of the policy. And for accounting purposes, and this was last month's discussion, for accounting purposes, you want to make sure that you're tracking every single loan that comes out to what it's paying off from the payment coming back. Because if you're going to be a true banker, this is like having a business on the side, just like Nelson said, right? Now you have a business of being a banker. So you have to have that pool of money where you're able to track, because once they, and by the way, we recommend monthly premiums are really a difficult thing to do because you're not able to access the cash value right away. So anytime that you can pay your premiums yearly, make the deposit and immediately take the cash value out and put it in your segregated account for use. That's going to be the most efficient, effective way to start attacking whatever your goals may be. It is also really important to understand that the management of the segregated account is completely up to you. You have the full freedom of saying, okay, I'm going to pay interest only back to the insurance. I'm only going to pay, or I'm going to add myself an additional 10%. And actually, let me go to that because I think
Well,
I have,
and so let
benefit.
me answer this because you see this question. So the question is, you're kind of answering. I just want to make sure that so if the payments are to the segregated account, when do you send the money to the insurance company? Is the question I suppose.
Okay, so that would be ideally under the ideal banking situation. That would be when the premium is due on a yearly basis, meaning that let's just assume that I have a premium come up. Let's look at this scenario. I have $8,640, and I have a $10,000 premium due, and I have built my segregated account. I've thrown in extra dollars, and now now I have, I don't know. Let's just say that I have 12,000. I would pay the premium first, throw the 10 in for the whole entire year, and then immediately take a loan right back out and put the money right back in your segregated account. Because when you do monthly payments, what happens is that you don't have access to the full cash value until the end of the year. So for this kind of strategy, when you really want to, make the most use and effective use of your dollar, you're always going to be more effective when you're able to throw it in and take it out and begin flowing, paying off and doing things right away. So,
right. So and
sometimes that's not possible.
managing account, because I'm kind of here where the rest is going. So you don't have to have all the loans paid off by the end of the year. Remember, this whole system is about you being a good money manager. So let's say you want to get really technical, and then you say, well, okay, I borrowed 10. Like I had a guy who borrowed $20,000 for a car, and I says, all right, so we need to create a payment plan. So I had him, okay, I pulled up 20,000. I said, look, let's charge yourself 9%. And I did a 3-year amortization level, and she's going to show you an amortization schedule. He said, well, I can pay it back in 3 years. Okay, so I created, here's what that needs to look like that you would send back. Now, he could send it back monthly, he could send it back quarterly, or he could send it back to the end of the year, but that particular loan would be extinguished, right? So
yeah, exactly. And I would also say, yeah, I also want to say this, right? There's going to be, this is what is called good debt. I know that people have a fear of the word loan, and I even hate the word loan, because really what you're doing is you're leveraging your dollars. And anytime, and even that 1% that the company's charging you to use that dollar, it means nothing when you are paying yourself back with and above interest. You're always funding it. But most importantly is that every single loan that you do must have some kind of a repayment schedule attached to it. Now, I've had clients, me included, who have a multitude of loans, so we consolidate them. Maybe I'll make one schedule and I'll put maybe 5 or different loans from different policies. I don't care where they come from. It's a total pool of money. So your vehicles are your multitude of policies. And by the way, if you have one policy or you have 10, the process is the same. The only difference is that the more policies you have, the more pools of money you're going to start building, that you start creating. So I have some policies where are strictly used, for example, to help with my daughter's college. I have some policies, for example, that are for a business, lending to my business. Those loans, and those are, because that's another thing, if you have a business and you take out a loan, you're able to lend your business operating capital, whether you go and you buy medical equipment. I had a chiropractor in California who he put in $500,000 into his banking system, took it right back out and went and purchased equipment because he was spending almost $8,000 a month in leasing of this equipment. Now that $8,000, the business is paying back to himself, right? The business is paying him back $8,000 a month with interest. And that's a tax deduction to the business because it's a loan that the business incurred. So this can be used also, and even to do private lending. If you want to be the person who's actually loaning, hard lending to others, it's the same model. So the use of the loans are multitude. We can set up whatever you want, but the process of the repayments and the strategy, they're all always the same. You put in your cash in, you take out the loan, you put it in your account, you pay off your debt, and then you pay back, into your segment, and then you put the money back in the policy yearly, you take out, and it's that is what creates the velocity. That's what creates wealth building. Right. Because as I showed you before, now that year 2, 3, 4. So if I put in, and I'm going to go back really quick, Curtis, I want to go back to this one slide because I feel like it's important to, hold on a second, to look in here, right? We're talking now that as years go by and as you're depositing, now you're 10,000, you're being able to pull out a greater number than what you're putting in. The more times that you're able to take advantage of this, the more leverage you have put on your dollar, the more chances you have of having that dollar earn you more dollars, right? And that's really the ultimate goal. So as long as you understand that this policies, funding these policies is not a debt. This is not, oh gosh, I have to pay my life insurance. The life insurance is one side of this equation. But what this is if you're having any dollars go from your paycheck to your Bank of America, whatever bank you use, and to pay something that with interest, you've lost the power to earn money on that dollar. If you were to flow that same dollar through your banking policy, still pay your card, but then be able to rebuild that cash and know that when you put it in, you're going to get a greater number, that's what wealth creation is. And you're right, Curtis, this could be 10,000, 10 million, 1 million premium. It's irrelevant what the funding is. The process continues to be the same.
Because if you bought a house, that's when everyone wants to buy a house. So if you bought a house and you had enough, you put enough in there, this is what we'd have to solve for, to pay, $100,000, $150,000 cash, then what we would do is we would help you, we would do this, but we would create maybe a 15-year amortization schedule or a 20-year, 10-year, depending on your cash flow, or 30, right? Because it doesn't matter because you own the bank. So that what you want to do is free up cash flow. And but if you pay it back faster, this is a more efficient when she shows your amortization schedule. So the thing is, if you put it in, so I'm answering somebody's question who texted me earlier. Yes, you can get it right back out. We've got to figure out how much to get in there. You can get it right out. But this whole system, I hope you're seeing, it's not about life insurance. It's about you being or learning to be a good manager of your money. Okay. So now, if you're unwilling to do that, this is not a strategy for you. Okay. If you just want to put your head in the sand and just put your money in a 401k and hope someday goodness and mercy shall all follow me all the days of my life, don't call Curtis. Because I'm not.
Which, by the way, I showed you that 65 number. You put in 4,000 and you got 12 or 13,000 out. Those are tax-free dollars. That most of your 401ks, IRAs, when you're ready to retire and you're ready to take an income from those, you have a tax exposure. And the problem is that we don't know what the tax laws are going to be at the time that you retire. We don't know what the market conditions are going to be. Oh, unfortunately, well, think about all the people that were to retire in 2020. I mean, those folks are not having a good day, right? But how were they able to know 20 years ago when they started their 401ks that this was going to be the situation today? You don't know. Furthermore, the government is the one that A, decides on the management of this money, but B, is the ones that can change the laws around these systems at any time. So today you can buy a 401k at this law, and when you're ready to retire, the law has now completely changed, and perhaps even the tax exposure has changed. So this particular system gives you a guaranteed look at your future. You're not counting. I don't care about the stock market. The stock, every single person that had a banking system this year in March 18th, when the market crashed, did not care because it didn't affect our money. It affected everyone that was invested in the stock market. And by the way, I'm not saying it's an and or an or. You can take money out of your banking system and go buy stocks. You can take money out of your and go buy a mutual fund. You can do investments, but you must flow your money through your banking system first. That's the foundation of the movement of your money. I want to also point out that let's just finish this thing so I can go to the other schedule. But I want to show that by the third month right here, he put in the 10,000 again. He took out the 6,240 to pay what? The MasterCard. And now all debts are paying full. He's taking that 150, he's adding it to everything else. And now the deposit is $470. I will tell you this, if you have the ability to pay more than any dollar over that 470 that you put in because of an interest will only make the banking value greater. So this is a way for you to really, really understand how to, anytime you get a windfall, anytime that you get an additional tax return, I don't care what it is, everything has to come through here. Because when I show you the illustration, I showed you in year 5, the policy dropping from a $10,000 premium to a $4,000 premium. And you can see that right here. And the reason I did that is because we encourage people to practice what's called layering of policies, meaning you have now a season policy that's cash flowing. You know that if you put in 4,000, you're going to get 5, 6, 7, 8, 9. Now we're going to stop overfunding this one, and we're going to open policy number 2. We're going to take that same 10,000, but we're going to split it, and we're going to continue to fund the base on the first policy and start a new policy with $6,000. Or 10,000 or whatever money you have. And that system will now start getting seasoned. And now you have 2 banking systems. And then you can have that for a few years. I mean, we have clients that have, the owner of our firm has how many? Like 42 policies, I think 42 policies now altogether.
Yeah.
Mm-hmm. And who are these policies on? They're on you, on your children, on your grandkids, on your nieces and nephews, on your business partners. You find the different places and the people that you have an insurable interest, and you own and you purchase and you pay for the use of their insurability in order to create your own banking systems. And when you purchase a policy on someone else, let's say that I purchase one on Curtis because Curtis is my business partner. If anything happens to him, I will be the owner, I will be the payer, I will be the beneficiary, I would have control of that system. If I choose to, I can always say, hey, I'm going to give you a gift. And by the way, for those of you who have children, there will be no greater gift that you can give your child than handing them one of these season policies when they turn 21, 35, 45, whatever. This is a multi-wealth generational tool where you can say, and I have a policy on my kids, and someday those kids will inherit a seasoned banking system that I will hand over to them. And they will continue to work. My daughter just opened her very first banking system. She put in, she worked all summer. She gave me $1,500 a month, a dump in, and she's putting $110 a month because she's a college student. But she's starting to see and understand the value of A, starting early, and we're going to talk about that later, but B is to really maximize the funding side of this. Okay. Now what I want to show you is the amortization schedule. And I took the total amount of all the debt, which was $20,889, and I put it in with an 8% interest. The 8% came from the average of all the interest that they were paying to all the other companies. This could be 5%, it could be 12, it could be 20. You charge yourself whatever amount you want to charge yourself. But I made it so that $470 that you see here, see these $470 a month? I told her that I don't want to pay any more than that, but I'm going to charge myself 8%. So it's going to take me 53 months to pay it off, but I'm going to make a revenue of $3,967.35 above and beyond. And what I want you to see, and it's interesting, when you look at whenever you pay, whether it is your automobile, your mortgage, every time you make a payment, most of your money goes to interest and very little goes to principal. When you do this strategy, I want you to pay attention to the principal part of this amortization. Most of the money goes towards principal and less money goes to interest, right? However, the more interest you charge yourself, the greater money you will have down the road to spend on other things. So in this particular scenario, I could change the equation. I could say, well, I want to make a scheduled payment of $900 a month. That will reduce the number of years that I'm going to have to pay. Or you can say, shoot, I lost my job because of COVID, or I'm having a bad year. Okay, drop that down to $100 a month. I don't care if it's $1 that you're putting back in. As long as something is going back in, the option of saying, I'm not going to continue to pay down this debt is not an option. Then you're not being a full, banking, you're not utilizing your banking system the way that it should be. So always remember this, for every loan that you have, there must be some kind of a loan repayment strategy in order to maximize your banking system. Okay? Curtis, anything else you want to add to this?
If those of you who read the book, the translation is don't steal the peas, right?
Exactly.
Don't rob yourself, don't, because people say, well, why am I charging to borrow my own money? Hopefully we cleared up that you're not borrowing your own money. And
right.
There's no such thing as a free money. Even your cash, like a lot of real estate investors on here, and they're like, well, I'm going to pay cash for this house. Well, there's a cost to cash, okay? And so if you don't understand that, then you don't understand money yet.
Right.
And so you have to treat your money, just if you're going to give a hard money loan at 13%, then you need to you need to charge yourself 13%, because if the property can't handle that, then you've got to look at, is your deal structured right? Okay. And so, it's all about financing.
Right.
And so for bankers, the house is collateral. So they think completely opposite from investors. Okay. And so when you pay extra on your mortgage, all you're doing is strengthening the bank's asset.
Right.
Okay. That's what right. Pay my house off. Well, all you're doing, the more equity you have, just remember this. So if you're on the other side of that, what's good for the bank is bad for you. Okay, because you can't eat equity. Equity has no rate of return. So if I was going to pay off my house, I would store it in here and then pay all off at once if I wanted to do that. So, but anyway, so you can keep going.
Well, the one thing that I want to say is, right, because at some point when you have a multitude of policies, now you're cash flowing, you're flowing all this money, you have loans outstanding. There could come a point, let's just say either at retirement or perhaps because there was a loss of a job or a disability, where your cash flow gets reduced and you panic. You say, oh my God, I have all these loans. No need to panic, because you can always ask the insurance company to sell off some of your death benefit and wipe your loan off. You can get rid of any loans by simply getting rid of some of the increased death benefit that it accrued in the policy. And I'll tell you this, whether that's a good strategy for those who can't pay, but what happens is then your banking closes. That bucket can no longer ever be funded again. So that is the last resort, because you don't want to spend all these years building your banking systems to then shut them down, right? But we have had situations where we have had clients who have had hundreds of thousands of dollars worth of loans. Things have happened where they become disabled, lost their jobs, their financial situation changed, and we did it. We just wiped off their loans and simply, closed that bucket, and life just kept on going, and they did not have to continue to make those payments.
So there's a lot of flexibility. Here's a question. Let me just get this. How would this work with a lump sum of money?
If you mean to put into the policy?
Yes.
If you had a lump sum of money, let's say in this particular situation, here's a $20,000 loan. Now you're paying them, let's say for a year, and you get this money out of nowhere. You can pay off this loan in 1 year. You can pay it off in 10 years. You can pay it off whatever. If you get a lump sum of money, I will continue to pay this off and open policy system number 2, number 3, number 4.
So you were saying, so I think this person means, I don't even mean paying off the debt. So let's say, could they jumpstart this system with the lump sum of money and start their banking system? Is that the question?
Yes.
In the chat, you can correct. I think that's what they're asking. If I had $50,000, I'm coming into $100,000. It's the one thing I tell people, it's not a deposit. I want to know how much you can fund that going forward. If that's how I think about it. So, but Yvonne, what would you say to that?
Well, you have to think about the rider, and let me go really quickly. And there's a lot of things that I have to undo here before, but let me just go back to this. So, if this kind of illustration that I'm showing you is called a continuous PUA writer, meaning that for the first 5 years, you're going to continuously add dollars. But when you have a windfall, a big chunk, you can add a one-time dump in. And you can schedule that dump in for any years. I can tell the company, I am going to come, I know 5 years from now, I'm going to sell my business. I'm going to have $100,000 or whatever. On year number 6, I want to open the bucket to have $100,000 deposit. This is why working with Curtis and understanding your financial plan is so important, because those are decisions that you make when you start building these policies. Now, once in a while, you'll get a great windfall. And our policies allow for you to put in 20% above, 20% less. You have a little bit of room to put in additional dollars. And I don't have that page here, but there's many ways that we can structure these policies to receive future premiums. What we have to be really careful about, and I know you've probably talked to most of your clients about this, Curtis, is the policy never becoming a modified endowment contract. Because we build these contracts right to that MEC line. The last thing we want is to make these particular policies a taxable event. Right. So when the policy gets to that particular level where it's in risk of becoming a modified endowment contract, which, by the way, for any nonprofit organizations, churches, anything at all nonprofit, there's no MEC limit. They can put in $1 million into this thing. Right. And there's no ramifications. But for us, the normal people, there are going to be limits. And that's why the layering of the policies is so important. And this is why it's also so important for you to, at the very beginning, get approved for us all the life insurance that you can. Start your banking policy number 1, hold a small little term with your additional, and as your life continues to get windfalls, more money comes in, then you start converting, because you're never going to have to prove insurability again. So the strategy is to get all the life insurance you qualify for up front, start the permanent policy with whatever little you can, keep a small term or a large term, but it's going to be way cheaper, and then grow your term and slowly but surely continue to move it from a term environment into a permanent environment.
Yeah, that's so important. I didn't know that when I first started doing this 10 years ago. It's just the stuff that you pick up as you start practicing this and who you're learning it from. That's why it's not about the policies, it's about the coach.
And furthermore, I want to say this, just because and what I'm trying to explain here that everyone's getting this concept is flexibility, is control. You decide how, when, where, how much, you tell us. And there's no commitment. If 5 months from now you say, listen, I got 20 grand, can I just pay this off? Pay it off. Let's take it right back out and let's do something else with it, right?
Yeah.
Every part of this equation, you are the person who controls. And for every single person, no 2 banking systems will ever be the same. Yeah. This is a personalized, individualized program that we're the coaches to help you put it together. But at the end of the day, you control how you want to manage it. And for some people is equipment financing. For some people is college, for kids. For some people is retirement. Whatever.
So let me stop there. Just a quick now. I may want to finish the debt part, but a question that's on the table, I just want to mention it so you can be thinking about it, is so how would you use the system in retirement? How would the lump sum start the policy? Basically, it's like, can I use this to so finish out, and then we'll answer that in the Q&A part.
Yeah, this is my very last slide, and I want to finish with this, because we have to think about time and money. And I'm going to show you some numbers to make you understand that the sooner and the earlier and the younger that you begin this process, the greater that your wealth will be at retirement. And when you see these numbers, you're really going to think, wow, right? If you're 25 years old, and you put in $5,964 a year until retirement, age 65, you will have gathered $1 million. However, if you wait until you're 35, you're going to need to deposit $10,545 a year. If you are 45, that number goes up to $19,955. And if you are 55, you're going to have to deposit $44,000 a year to make it to that $1 million retirement number. So I want you guys to always think of the difference between you either have time or you have money. I've got people in their 50s that come to me and say, can I put away $200 a month? Well, unfortunately, that's really not going to accomplish very much, because at age 55, we don't have the time, right, to grow that money. Now, if you're 25 and you're giving me $200 a month, that's a great start. That's the way that you build it. So this is why when we talk about multi-generational, not only are we talking about you having your businesses, but to teach your kids about banking, to have your children start early. Because by the time that these kids get to be in their 50s and 60s, their wealth would have it's called multi-generational. You have passed down your wealth, and someday when we go and meet our maker, right, we go to heaven. And I don't know if I will go to heaven, but some people will, I guess. A death benefit, right? When because there is a death benefit component here, right? At some point, I'm going to die. I'm going to leave millions of dollars to these children. Will they be prepared to handle the management of that money? And furthermore, are the buckets available? And then they will build that banking system, and that will go into their grandchildren and their children and great-grandchildren, and it will leave a legacy and the ability to pass down wealth. And guess what? In a tax-efficient way. There has not been one dime of tax paid here because death benefit is tax-free. So the greatest way to leave money to your children is not stuck in an IRA. Trust me when I tell you, if you go to heaven and you have an IRA that's completely loaded, to pass that down to your heirs, first of all, they got to pay all the taxes that are due, right? And second of all, it's the worst. Now, if you have your banking systems, it's seamless, right? The money just moves over to the next generation's banking systems, and on and on and on. Okay, so I know it's 5:06, and I apologize, I went a little bit over. So open it for questions, comments?
Yeah, so let's talk about the retirement thing, and then if you have an answer, because here's the point I want to make with that. First of all, $1 million is not enough.
No.
All right, so you can't accumulate. So in our system, we call it the accumulation theory. So there is no scenario where I believe you can accumulate enough money, reach 65, and live off that pile of money, right? So, but you do want to fund your banking system, but I believe you use that money to create velocity by buying other cash flowing assets. So if you buy 2 rentals a year, and let's say you can net $400 a month, and you do 2 houses a year for the next 5 years, that's 10 houses at 400, that's $4,000 a month. So that's $50,000 a year. And you may use the policy for the down payments and then get a loan for, like, let's say they're $100,000, just make up a simple number, and you save up 20 grand, you take a loan. See, we talked about getting out of debt, but see, once you've recaptured that $400 a month, at the same time, you should be focused on what? On the, not so much on your net worth, but you should be focused on every quarter, what we talk to our clients about, are you building your cash flow? Are you growing your passive income? Are you buying assets? That was the asset, something that generates cash flow for you. And so if you're doing that and you add your banking system, everything you do gets more efficient. It's like having find a plane with a tailwind. And so that's the key. But so I'm going to raise your hand. I will see if you want to talk. I will see if I can unmute you and let you ask your question. How did we do that last time? I always forget how to do this.
Hey, Curtis.
I don't know.
Okay. Who's that?
Curtis, can you hear me?
I can.
This is Troy Slaffy. Just real quick, first and foremost, Yvonne and Curtis, thank you for such an amazing presentation. And one of the things, Yvonne, it's funny because when you first showed this, it was something that I had begun doing already.
Mm-hmm.
And it's always great to hear when someone else has the idea and doing it, and it's in your mind and you're like, ooh, I'm gonna do this because I paid off my car, I paid off all my credit cards, and cash flowing in a sense. So now literally taking and revitalizing some of the term policy into whole life, opening up more of the PUA so that you can store and have more and grow more. But I appreciate you for bringing this concept forward. The one question I had real quick in regards to insurability of business partners. So I'm going to use me and Curtis, for instance. Mm-hmm. If something happened to me, he would lose out on money because I'm within his organization. Mm-hmm. does that then create an insurability
Yes.
between me and him?
Yes, and I'll give you a perfect example. The owner of the firm, Alpha Omega Wealth, who's also partners with Practical Wealth Advisors, he has a policy on my life that he owns. Alpha and Omega Wealth owns the policy. Alpha and Omega Wealth pays for the policy, and Alpha and Omega Wealth is the beneficiary of the policy. And it's a multi-million-dollar policy. I have no control over it, but it's on my life because the value that I bring to the organization makes it an insurable interest. So you can have, that's called an executive type of policy. You can do it on it can be a buy-sell agreement when you have partners. It can be an executive bonus. You can actually talk to business owners for deferred compensation. We build these kind of policies for employees that the company matches. If they put into the PUA, let's say $100, the company matches $100. And upon retirement or upon leaving the organization, they get the value of the cash value out. But what does that allow the company to do? That allows the company via the death benefit to recapture the money that they paid, right, to that employee. So it's a great strategy. By the way, any policies that are business owned, right, that's also an ability to get some tax deduction. So it's a really effective way. And many, by the way, many large corporations, Disney, Pamper Chef, J.C. Penney's, they will utilize cash value life insurance
Jack
to help
Welch.
just get started.
Yeah, Jack
Yeah.
Welch from GE. His retirement was coming out of this multi-million dollar insurance, hundreds of millions of dollars of death benefit. He was pulling out hundreds of thousands of dollars a year.
Sure.
Retirement.
Tax-free dollars, right?
Tax-free dollar, and he passed away. And then all of those hundreds of million dollars went back to GE because they owned the insurance on him. You know, Jim Harbaugh.
Yeah.
And
That's right.
football coach of Michigan, and Dawn Staley, who's from Philly. If you're local around here, who's won the national championship with South Carolina, she has the same plan. It's called split dollar plans, funded with insurance. The university pays for it, and then they get it back. Let me answer a question. So what happens is, who's the question? I just typed the answer, but somebody asked me if I pay extra on the premium, does it pay the loan down faster? Yes, and then. So what happens is the insurance company is looking for the money back at 5%. So should you pay it back at 9%, you're going to extinguish the loan. But what happens is if you keep making payments, you technically, so when I say interest, we're kind of doing air quotes, right? Because all money goes in the policy as premium. So there's the base and there's something called the paid up additions rider, which is where the magic happens. And so what happens is when you pay, so let's just keep it simple. So if you had $1,000 of interest and Ameritrust is charging you $50, right, on 5%, right? So now you're earning $40 on that money, right? So now if you said, I'm going to charge myself 10%, so you paid the company the money that Ameritrust is looking for, well, what happens to the other $50? It goes into your cash value. So utilization, Melissa, right, is how you see it's designed to be used, and that velocity and your behavior is what control your behavior, meaning you being a good money manager is what increases the efficiency of that policy. So all the extra money goes to buy more premium. If you're new, so some of these people I know that are new, you got to get the book and look at Sister A, Sister B, and become your own banker and the equipment financing to understand the flow. Because I won't even let, like, if you're new on this, so I say that to some new people, I won't even let you do this unless you read the book. Either will Troy, okay? And so that's the homework. I mean, if you can't read a 91-page book to secure your financial future, I don't care how busy you are, okay? That's a 2-hour read. You have to do that because it's that important.
Yeah.
Okay. It's that important.
And I want to answer, there was the question in here that I saw that said something about if you have money in your retirement account, do you recommend to pull the money out of your retirement and pay the taxes? Okay, I want to say this. We will never, there's a very fine line when we're talking about what it's called qualified money. Qualified money, which is your IRA, 401ks, that's money that you have not paid taxes on. And it is normally not advisable, especially if you're before 59 and a half, for you to incur, there's a 10% penalty above and beyond any tax that is due. And we will never recommend that you destroy or you incur any fees to either a 401k and or let's assume that you have another policy that you have had for a while. We're not going to replace perfectly good whole life contracts. We don't want you incurring unnecessary fees. With that being said, there have been situations where it absolutely makes sense to get the money out of that IRA, pay the penalty, because we can show a way that the policy will grow to make that up. But that has to be very carefully reviewed. There's got to be an accountant involved to make sure that there's no unnecessary fees. And that's the problem with qualified money. Any money that you have put in this retirement plans for so-called governmental retirement plans, they're illiquid. They're not, it's not easy, A, to access, but B, the taxes and penalties may not make it worth. So that has to be an answer for each individual person. I would have to look at the IRA, I would have to see the fees and so on and so forth. The next question is what happens if you're over 59 and a half? If you're over 59 and a half, all you do is your taxes. You do not have to pay the 10% penalty. So if you are someone over 59 and a half and you have 100,000 sitting there, worst case scenario here is that if you take all the money out, realize that you're going to have the entire tax exposure at your current tax rate.
Right.
And that's another strategy. Sometimes
that's a distribution, and that's all money comes out of qualified plans as ordinary income.
Right. That's why qualified plans, as far as we're concerned here in our firm, because we're 100% banking specialists, we never recommend. We don't want our dollars, because think about what's happening. You're putting the money into these 401ks, these IRAs, and they're paying you some percentage, but the financial firms that you're buying this from are taking that money and doing what? They're doing velocity. They keep loaning it to give it to other people. So they're making, but they're cutting you the ability to have the flexibility to manage that money. So you're locking money up, right? So whenever you have the opportunity to begin a 401k or a banking system, always choose a banking system, because you will incur the ability to have flexibility. But if you already have one, you have to, and we have calculators, by the way, where we can put in, and this is a meeting that you would arrange with me and Curtis, we can put in in the calculator how much you have, how much your fees will be, how long will it take the banking system to grow to the point where it pays whatever fees or taxes you have to pay. So we have a strategy, and sometimes we will say to you, the fees are far greater than the benefit. So we would recommend do not touch your 401k or your, I have had clients who have done loans on their 401ks at a very low interest to fund the policy, take the money right back out and repay those 401k loans. There's a whole argument, and that's a whole other training session, and we'll be happy to do a qualified plan versus banking class next. I think that's an important discussion to have.
Yeah, that's a good one.
Where I can show in the calculator, putting a policy right next to an investment vehicle and then running those numbers for the 20 years until retirement and really seeing what is the end result. And I will tell you this, every single time that I've done that, the banking policy will always win for two reasons. One, because there's no taxes. Taxes will eat about 30% of whatever you have invested. So if you're someone that has $100,000 sitting in a 401k account, you don't really have $100,000. You have 70, right? Understand that what you get on your statement is not the reality. You must always remember that you have to have some kind of a tax exposure. Number two, management fees. IRAs, 401ks, they have huge management fees that you never even see. But that lowers your rate of return. So we can do a class on this, Curtis, if that would be something that
here let me throw my 2 cents on the retirement thing. So I personally am not a big fan of, it's like, this is not a retirement account. I like to have, so let's say, for example, I've got somebody that loves their mutual funds, right? So, but we'll fund their banking system so that what happens is if you're using that for retirement, then what the policy does, what the banking system does is, if the market is down, but you need some cash, the policy protects your baby, your stock fund, because you can access the policies without having, because the only way to get money out of the equity is to sell the shares, right? So if it was at $100 a share and it's now to 60, if you sell it, that's a loss. Whereas if you got money in policies, you can access your capital to buy you time for your market to go back up. So if you love the market, this helps protect your baby, right? I'm
Yeah.
not a big fan of perpetual policy loans. So there's a whole strategy out there of, so if you know me, I'm not a big fan of universal life, which we might do a talk just on that. But, that whole thing is tax-free retirement. That's using it as a Roth IRA alternative. It just depends on how much money you have in it. You can't put in I had somebody like, oh, if I put in $300 a month, can I use it for retirement? No. Okay. When I talk about the third pillar, passive income, you don't have to work for, you can't outlive. I'm talking about you learning how to buy cash flowing assets so that you can create passive income twice your expenses from the asset you buy or build. There's no magic box. This is not a magic box, and there's no financial instrument that will take you to glory. Investing is about becoming something, not about buying something. This is just a place to store cash and get control of the banking function of your life. So I want y'all to hear that. Okay.
Hey, Curtis.
Yes.
Just real quick, there's another question out here. When you put your payments in the segregated account each month, when do you actually pay the loan back to the policy?
That's a really good question. And I'll tell you that some people pay it the same month. Some people pay it quarterly, send a payment quarterly. Some people pay it annual when they pay their annual premium. I do everything annual. I hate monthly payments. I hate having little payments. I mean, when I say everything annual, I mean car insurance, anything that can be paid for the whole year gets paid for the whole year. So that is an individual strategy. There's no right or wrong answer here. Is whichever way you're most comfortable. Me personally, I send them once a year because I am a single mother and I want to have access to my cash. So I wait until policy anniversaries to pay premium and interest at that time.
But you could be putting money in. So let's say, for example, you say, well, all right, I can save. So if you dump in and you take a loan out, well, you got to redirect your $800 a month savings into your segregated account. So when your anniversary is due, boom, there's your money to pay the premium.
Right. And in my particular situation, I got to take a loan right back because, I have a kid in college. I have a kid that has some learning issues. I'm a single person trying to manage my life. So, but in some people's situation, they might not need to take the money back out into the segregated. There's nothing wrong with leaving money in the policy either, right? But when there's a major purchase to be had, you want to buy a car, you want to go on a vacation, you go on a $10,000 vacation to Disney, take it out of your banking system. Put a loan repayment back. That vacation could, because it's infinite. That's why it's called the infinite banking concept.
This is where, individually, it's a individual strategy because it depends on if you've got a business, if you're a real estate investor or broker, and I've got real estate investors that get big checks that from time to time.
Yes.
And so, we don't have them on, let's say I have the base on monthly and just have the PUA open so that when they know, like, I got this flip, they'll be finished in 90 days. I'm going to dump $30,000 this thing. And so we set up to hold it. So it really depends as we're looking at it. We look at each person individually. So listen, it is our time, 8:29. So what I want to say is that if you're interested, email us and we'll send you the replay. If you're interested in having a free debt analysis, reach out to myself, Troy, and what we'll do is we'll get you that form that Yvonne showed, and then we will, kind of organize your debt, show you if you've got policies. And if you've got policies with other companies, we'll show you how to manage them and use them properly and create the segregated out. Folks, this takes study. I mean, this is why we're doing this. You've got to learn this stuff. This is not a set it and forget it strategy. It's all about you learning to be a good, in your life right now, we've got two roles when it comes to money. Production, which is you got to make money and get better at making money, but stewardship. So right now, what we've been talking about is stewardship in the first pillar of the four pillars of a strong personal economy is freedom from debt to others. Okay.
Mm-hmm.
And I think Yvonne has done a brilliant job of explaining that to how to do that, right? The next pillar is ready cash. So you can see how they're all happening at the same time. Cash when you need it, right? passive income you don't have to work for, you cannot live. So you could pull money out of it. That's not my favorite strategy. I teach people to use the policy to buy assets. I want the retirement money coming from the assets that you buy.
Mhm.
And then a legacy of wealth and wisdom, which means just like what she did with her daughter and we're doing our kids, you fund them. See, we do these in lieu of 529 plans because that's a one-use, single-use product where your money's in jail, so to speak.
Mhm.
And so now you got stuff that you can do. So you got to a lot of times people have the money. It's just about repositioning what you already have to make that work harder for you. So we're always not trying to incur a new expense. We're just trying to rearrange because if first rule of money, most people think the key to growing their money is investing, but it's not. It's fine, you know, it's becoming more efficient. So if you're going to create maximum wealth, you got to create maximum efficiency. So 34.5 cents of every dollar is leaving your personal economy in the form of debt, and you're saving, and he's benefit out 10%. You're trying to get 15% interest on that 10%. How about we recapture that 35%? That's efficient, okay? And that's where you start. And so everybody's different. Some people don't have debt, but they've got other things they want to do to reposition money that's earning less than 1% to make it work harder. So everybody on the call has a little bit different problem. That's why the next step is to get with one of the coaches and schedule a review of the book and also a review of your debt or your entire personal economy, and let's see how to design your system to make it do what you need to do.
Yes, and I want to end with there's no right or wrong, right?
Right.
Every situation is individualized, and and it doesn't mean that those goals cannot change as your life becomes different. I have had people have gone through divorces. We had to split banking systems, and then they get remarried, and we start. So this will forever evolve and forever will grow. But at the end of the day, that idea that we all, you know, prior to learning this, that we all live where it never seems like we will ever be able to get from underwater. It was like you make money, you spend the bill, you pay the car payment, then you have no money left in the month, right? This changes that equation. This changes the ability of you to really, every dollar in your system, you want it to positive flowing, meaning you're growing at a greater number. You don't want to be, because right now in the normal way, I just showed you, for every dollar that you get in your system, you only are really able to use 60 cents, because 40 cents are going to go between interest and payments to other people. I want to use, for every dollar that I put into my system, I want to have access to $1.25, $1.50. That's how you create wealth.
There you go. So guys, thank you. And so we'll send out the recording of this. I think I decided to leave recording and get the question and answers because I think the question and answer is important. So thanks for hanging in with us. And listen.
Yes, thank you, everyone. Happy holidays to everyone.
Yep. And then we'll see you in January.
Happy holidays.
Here, look your email because we have a couple more scheduled before the holidays start. And guys, I thank you. Hope you learned something tonight. And have a great evening, everybody.
Thank you so much, Curtis, for inviting me.
Thank you, Yvonne.
All right.
Awesome job. All right. Bye-bye.
Thank you.